There's some interesting things to be careful of, but also risk and opportunity over the next 4 to 6 weeks. There's obviously a lot of speculation in the market around what sort of data is going to come out with these upcoming trials around the potential coronavirus vaccine. So we're becoming increasingly of the view that you're likely to get some positive data around. There's so many shots on goal. There's been so much money invested in this, and one of these phase 3 trials is likely to show some efficacious or positive data, and we think that that's potentially going to create some quite good opportunities in the market. Coming into COVID, obviously the sectors that were impacted the most have been, a lot of those cyclical sectors. So you saw financials and energy, and then tourism and leisure have also been hit pretty hard. A few of those sectors probably have some medium-term structural headwinds. So financials, for example, if you're a spread business, lower rates aren't helpful, but some of the other sectors will clearly benefit from a cyclical bounce. One of the sectors that has clearly benefited is some of these stay-at-home or work from home. If you basket them up, retail is obviously a part of that. I think it's a little bit early to get too negative on that part of the market. It's become, I think to your earlier point, it feels like it's a little bit of a consensus view now that these stocks are over-earning and they're about to roll over. And I just wonder if that continuation of the strength in the earnings was to continue into AGM season, for example, could see another leg up in these names. One of the stocks that's we think is really interesting at the moment is Sydney Airport. And our framework for looking at whether or not some of these stocks are pricing in a recovery or not is really we've been looking at, okay, what did this company earn on a normalised basis? So in FY19, it's a pretty normal year. How did that company perform and what did it earn? And then say, okay, well, based on those earnings, where did that company trade for the 12 to 18 months on a multiple or a valuation basis coming into that? And what sort of valuation would that imply? Now, if we discount those earnings back and have a look at what the current share price would then imply based on that discount, and there's a company like Sydney Airport, for example, that on that basis is implying that it's 5 to 6 years, for example, to get back to that normalised earnings profile. And I think that is giving you pretty good risk reward. So they've also done a capital raising and they've pretty much taken the balance sheet off the table. So if there was some delay, you've got a balance sheet that's strong enough to hold you through that process, but you're also getting, a really a monopoly style asset at a significant discount. You don't get many opportunities like that in your life.